I got a guy that can do it for about that sort of 150 mark at the moment. Now, obviously, if you're watching this in 2 years' time in the history, inflation, prices change and everything like that. But right here, May 2026, yeah, just sort of like a little two-bedder sort of thing here. They make it in the factory and then ship it on the back of a truck, which you can see gets craned into place. So fully council approved. The inside of it looks, this is a slightly different setup. So this is more like a 2-bedroom. So what they've done in this one is they've got one roomie and then bolted onto the other side of that, which is the other doors there, is another roomie. And that one there is more like, pretty sure he's got a photo like that one there. So one roomie would be that inside one there. Yep, so they can add onto the patio and everything like that. And that can just be craned straight into your site. That one there's going to be a little bit more. What I'm talking about from 150 point of view is that guy there. So 1 bedroom this end, kitchen in the middle, another bedroom, a bathroom at the other end there. You can see that it's overlooking the Gold Coast, and that there would be 150 including council approvals. It increases it. It actually makes it so much better. So for that $150,000 investment, you're looking at around about $450 to $550 per week in rent, depending on the location. So from a yield point of view, just on that one asset, I'm just going to quickly do a little bit of mathematics right now. So let's just go 450. That divided by 150. So you're looking at around about a 15.6% yield on just the 450 investment, which moves the needle on your house as well. So if you're looking at, on the 150 investment for putting the granny flat in, you're looking at around about a 15.6 yield. So it brings it back to being closer to neutral gearing. So you've got positive gearing where the property's income producing, you're having to pay tax. So it's earning $1 and you're having to pay whatever your marginal tax rate is. So if that's 30 cents on the dollar, you're having to pay 30 cents to the tax man, and it leaves you 70 cents in your hand. If your tax rate is 47 cents in the dollar, then you're paying 47 cents and it's leaving you 53 cents in the hand. Neutrally geared is where it doesn't cost you $1, but it doesn't make you $1. So it's neutral. So over a 12-month period, a neutrally geared property might be $500 in the black, it might be $500 in the red, but that small little loss of about $1 a week or 90 cents a week is nothing, okay? Then you've got negatively geared, and negatively geared is where you spend $1. So you go and spend $1. So you go and buy, a $5 coffee hypothetically, right? The tax man, because it's negatively geared, and that's what they've removed, is that negative gearing component. But there is a way around that, and I can explain that in a minute. They used to give you, if your marginal tax rate was 30 cents in the dollar, they would give you $1.50 of that back. And if your marginal tax rate was 47 cents in the dollar, they would give you around about that sort of $2.40 back, roughly. Okay, they've got rid of that. That doesn't exist anymore. So now you're spending $1 to get nothing back. By putting in the granny flat in the backyard, that's going to help alleviate that stress. So it's going to bring you closer to that neutrally geared or potentially even positively geared on the property. So you're not having to spend $1 to get nothing back. In the old days, every investor used to go out there chasing that negative gearing to get that money back from there. And over time, the property would go from negatively geared and transition into a neutral geared status, and then it would transition into a positively geared status. Now, the, smart investor or not so smart investor, whichever way you want to look at it, would race out there and sell those positively geared properties, lock in that capital gain, and then they'd go and buy another negatively geared property to chase that negative gearing aspect. Me personally, my strategy and my recommendation for clients is we want positively geared. You want that cash flow. You want to keep those properties for the long term with the idea and the ability that they're going to pay you rent now and into the future, and you're going to be able to make profit off that, and you're not going to have to work as hard. You could take a job that you love more than having to earn that paycheck, because you don't need that bigger paycheck because you've got that rental income coming in from the property. What they've got rid of is that negative gearing structure. So what we're looking for now is we're looking for properties that are really close to, if not positively geared properties, so it's not costing you money to hold it. And that first step in the coin is that neutral gearing. So you want something that might be, at worst case scenario, 100, 150 bucks a week out of pocket expense. And you can cop that on the chin, because the old method was $400 a week. And if you're at a 30 cents in the dollar marginal tax rate, you'd get $120 of that. So you were copping a $280 loss. Well, at $150 a week, it's less than that $280 loss. And it's not such a bitter pill to swallow if you're going to get that capital appreciation. And just sitting there and going, well, I've got 2 rentals on this one property. These 2 rentals, I'm going to be able to put up by $5, $10, $20 a week in rent. And in, 3 or 4 years' time, these properties are going to be neutrally geared, or even in 2 years' time, these properties are going to be neutrally geared, depending on what the market does. I've got some thoughts around about that rental market, which I'll share shortly. And you're wanting to get to that positively geared stature, and then that gives you the ability to go buy another one. And even though you can't negatively gear, the profits of one house, from my understanding, and you need to check with your accountant, this is not financial advice or tax advice. My understanding is if you're making $100 on this house and you're losing $100 in this house, they cancel each other out. So you're not negatively gearing, you're just cancelling out the tax of this guy on the loss of this guy. Discuss that with your accountant, because that legislation may change between now and when it comes into law.